Well, the key challenge in the current global macroeconomic environment for the Reserve Bank of India will be maintaining a stable rupee. Now, the RBI is in the midst of its MPC meeting, and we will get a disclosure from the RBI Governor Shaktikanta Das at the end of tomorrow, or rather tomorrow in the morning. We will get an address from him. But Citigroup has come out with its prediction on how on whether the RBI will be able to maintain a stable currency. And two things, of course, affect currency for us. One is oil prices and the second is foreign flows. Well, oil has hit $90 a barrel and in fact breached that quite comfortably in the last few days. It's of course cooled off since, but that's broadly the benchmark it has been at. And that may take a month or two to translate on the trade deficit, and of course the trade deficit is what will impact currency. And the current trade deficit is lower for the month of January when we look at it versus December, of course largely due to oil prices cooling off in December, and that translated in the month of January with a lower than expected trade deficit. That trade deficit is expected to widen. Mind you, when oil prices go up, it takes a month or two of lag to actually translate to the trade deficit, and that's exactly what is expected to happen even now. With the oil price rise, February and March, it's expected to have a larger impact on the trade deficit. Citi expects that oil prices, though, will come down in the medium term. This is broadly against the consensus expectation, wherein most houses are expecting oil prices to breach their $100 a barrel mark. Citi believes that the oil prices will normalize or will cool off even without the Iran issue being resolved between Iran and the US, which means that supply will increase if that issue is resolved, which means that oil prices will cool off. And Citi is saying that even if that does not happen, oil prices will cool off to the $80 a barrel mark in Q1 of FY23. So it expects the first half of FY23 to actually have a positive balance of payments despite there not being an oil price cool off below that $80 a barrel mark. And what Citi believes is that even if oil prices don't cool off substantially, which is towards that $80 a barrel mark, the RBI will ensure that the rupee will maintain that 74 to 76 rupee a dollar range, which is what they are currently seem to be targeting. Moving on in terms of foreign flows, well, one of the major problems that we have seen in recent months is the FI selling pressure that's come in, which is what is impacting the rupee as well. The increasing interest rates mean that Indian companies, though, have front loaded on some of their bond issuances, especially foreign borrowings, and that means that the FI outflow of around 4 billion or so has been offset by around 4 billion of inflow from foreign bonds issued by Indian companies. And one more major factor was always going to be the bond index inclusion of Indian bonds, and it's clear to Citi that that will not be happening. Citi now believes that that will not happen in FY23 either. That's their expectation. Earlier their expectation was that that will happen in FY23, and the reasoning for this is largely due to the tax reforms, which they believe there are larger hurdles to that tax reforms given India's inclusion in the BEPS agenda, which is the base erosion and profit shifting agenda initiated by the OECD. So they don't expect this particular bond index inclusion to happen, which will curb foreign flows. So earlier they were expecting the balance of payments to come in at around 49 billion after the bond index inclusion. However, subsequent to this revised position that they have adopted, Citi believes that the second half of FY22 will have a deficit of $9 billion, and hopefully if oil prices do cool off to that $80 a barrel mark, the first half of FY23 will see BOP surplus of 4 billion, and the second half will see oil prices cool further, which will see a BOP surplus of around 21 billion, taking the FY23 surplus of BOP to around 25 billion versus the earlier estimated 49 billion, largely due to the bond index inclusion not going through. That's broadly Citi's view on BOP surplus and deficit for FY22 and 23.